The trade war is roiling equity markets, but it is not likely to cause a U.S. recession, no matter what the bond market yields are saying. Economic expansions do not end because of old age. It takes a policy mistake, such as a debt bubble busted by high interest rates or some other trigger. In this case, debt levels are quite high, yet the Fed has removed the threat of an interest rate policy mistake. So if this expansion meets its demise, the trade war may get most of the blame for disrupting economic growth. In the peacetime decades since World War II ended, there have been massive expansion of global trade, resulting in complex and interconnected global demand and supply chains. The trade war has disrupted how businesses see their supply and demand chains, and it quite reasonably means that businesses have taken a step back and they've slowed investment plans. U.S. businesses that depended primarily on China as a source of goods are looking to diversify their supply chain. American farmers, especially soybean farmers, have been hit hard by China's response to U.S. tariffs to curtail buying. Are all of these developments enough to cause the U.S. to enter into a recession? Probably not. The U.S. economy is consumer-driven, and the consumer is powered by confidence in their labor income. When unemployment is relatively low, and when most folks are working, consumers will tend to keep on spending. Moreover, the current trade war driven by the slump in business investment is not likely to be enough to do anything but lead to a little more sluggish economic growth than otherwise. That is, the trade war is taking its toll on equity markets because it hits company profits much harder than the trade war has hit consumers. The longer-term impact of the trade war will depend in part on how it ends. Still, for many businesses, there will be no going back to the old supply chains. Even if China resumes buying U.S. agricultural products, there will be a well-founded reluctance to count on Chinese demand as a permanent feature of the market. That is, globalization and world trade have been disrupted, whether or not a deal between the U.S. and China comes soon or never at all. Businesses are now treating the U.S. tariffs as permanent, even though they were initially imposed as bargaining chips. Tariffs are taxes on the world trade system. It makes little difference who pays them. Global trade is going to be negatively impacted. The U.S. is more insulated than most economies, but the U.S. will feel some pain. It's just not going to be enough to cause a recession. And on a more optimistic note, this long-lived, durable, record-setting economic expansion has many more quarters to run, even if it's not going to run very fast. I'm Blue Putnam, Chief Economist, CME Group.